Hello and welcome to the Financing a Sustainable Future podcast, brought to you by the Initiative in Sustainable Finance, funded by the Global School of Sustainability here at LSE. I'm Tom Gosling, Professor in Practice and Director of the Initiative. This is a podcast where we talk to LSE academics about their research on sustainable finance in a way that is accessible for practitioners. And I'm delighted to be joined today by Martin Oehmke, Professor of Finance here at LSE, to discuss his paper Green Capital Requirements, co-authored with Marcus Opp of the Stockholm School of Economics. And so, Martin, a very warm welcome to you.
Thank you very much for having me on the programme, Tom.
I'm delighted we're starting this series with your paper. I mean, for one, it's a great paper, but secondly, it's a theory paper, and I think that theory papers often don't get enough attention in practitioner discourse. So could you give what is the role of theory in finance research?
I think that's a very interesting question, Tom, because not only among practitioners, but I think also more generally, even on the research side that I see every day, there's been probably a decrease in, say, the number of people working in theory and maybe also the attention that's being paid to theory research. And of course, since I work on theory, my view continues to be that theory is very important. And I try to convince people of that through my research, or perhaps also just talking to people and talking to policymakers and practitioners. I think a good starting point, if you want to think about the role of theory and also perhaps why at least some people have paid less attention. When I started my career, 2008, 2009, right after the financial crisis, I think there was a lot of discussion. Well, we have all these models, theory. People think of them as reflecting, say, reality, and then everything went wrong because we believed so strongly in what the models were saying. And to me, and also the way I think about my research, that's a misunderstanding of what theory is trying to do. But what I try to do in my research more broadly, and also in this paper, is guide our thinking. Could be policymakers, could be practitioners on a particular issue. In this case, it's going to be related to bank capital regulation. In the past, I've worked on things on derivative markets, on sustainable investing. And I think of my models, of course, not as a reflection of what's going on. Markets are complex, regulation is complex, the world is complex. So I think a good analogy for what the type of research that I try to do tries to achieve is to provide a map. Right? The map doesn't have everything. It doesn't have all the details of the environment on it, but it has the important turn left here, turn right here, the important streets. And I think when it comes to, say, financial regulation, policy more generally, having a map like that doesn't mean every trade-off, everything is on there, but I think it's going to help hopefully guide policy in the right direction, guide what practitioners do in the right direction, and elevate the level of the discussion. A model that I or somebody else writes down is always, I think, a starting point for a discussion, and it makes it concrete, what we're actually talking about. And people who see my models might agree or disagree, but at least it's clear what the issues are that you're discussing.
Well, and importantly, that can stop you going in completely the wrong direction, even if not precisely the exact direction. So I think that's a really compelling description. In this paper we're going to discuss today, you look at the implications of central banks taking climate risks into account in capital requirements. What interested you in this as a research question?
Generally, in my research, I'm interested in issues that are, let's say, relevant beyond just the world of modeling, right? Real world policy issues where perhaps having this map that I just mentioned or having that model can provide some guidance. And for this particular paper, I and my co-author, Marcus Opp, we were motivated by the fact that we thought the policy discussion, for example, at the ECB, maybe also at other central banks, had maybe gotten ahead of what we know conceptually. There were already years ago policy proposals floating around about doing certain things to bank capital regulation. The buzzwords, and we can discuss those in more detail later on, are things like a green supporting factor, relaxing capital requirements for low-emitting firms, or a brown penalizing factor, higher capital requirements for polluting firms. But when I saw those policy proposals, I always thought that we are way ahead in the policy discussion of what I say, as an economist, believe are things where we have good guidance. And so the hope with this paper was to try to steer that policy discussion in the right direction, and to help central banks, for whom, of course, the topic of climate change and climate risk has become a really important topic, to try to figure out where should they position themselves in that field.
Before we get into the results of your paper, I think it would be helpful for our listeners if you could just set a bit of context about why it is we have bank capital requirements, what they actually are, and what we hope to achieve through them, how they affect lending, for example.
Yeah, so this is, of course, one of the classic questions people in banking research have thought about. Banks have access to certain things that other financial institutions don't have access to. And so, we make this broad distinction usually between the banking sector, the regulated banking sector, and say what people might call non-bank financial intermediaries. And so banks can do certain things or have access to certain things that some other financial institutions don't have access to. One example, and that shows up in the model on the paper that we'll discuss, is deposit insurance. Right, so banks can issue deposits, and those deposits are insured by a deposit insurance fund, and that's something only banks can do. Right, and there are also certain lending facilities that at the central bank that you might only have access to if you are a regulated bank. And so the flip side of that is that there is, for those special things that banks can do, the regulator puts in place certain rules, capital requirements, liquidity requirements, effectively to make sure that banks use these facilities that they have access to in a prudent way, and that they also, given that there is to some extent perhaps a backstop from the government, or at least liquidity facilities, that they don't, broadly speaking, take on too much risk, and that we're in a 2008, 2009 situation again. And so capital requirements are one of the key pillars of this type of regulation. If you in practice look at bank regulation, the Basel Accord regulates banks, and one of the key components of that are capital requirements. And so the idea of a capital requirement is that a bank, if we think about it in simple terms, the simplest, my simple type of model that I would write, there's a bank that makes investments, for example, gives out loans, so that's the asset side of the bank, and then it finances those investments in a particular way. Some of that financing will come from, say, deposits, so maybe me and you, we've deposited our paycheck in the bank, and then the bank can lend out that money. And then some of that funding is going to be in the form of equity, shares, as we also know from regular corporations. And the problem with deposit funding is that it's debt, it's short-term debt. There can be runs, particularly if we look back in history on deposits. And so these types of financing, deposits, but also other types of short-term debt, when the bank's in trouble, usually those people are not there to absorb losses. But we want the bank to be able to absorb losses because we don't want bank failures every other year, and then perhaps the government having to bail them out, or the deposit insurance fund to pay out. And so that's where capital requirements come in. Essentially, it tells the bank, well, for any loan that you make, perhaps depending on how risky that loan is, there's a certain fraction that you have to finance using equity and not deposits. And this is something that's been around for a long time. But of course, then in the last few years, the question has arisen, and that was the motivation for that paper, whether new risks, such as climate risks, should be reflected in capital requirements, and whether more generally they should react also to how much carbon certain companies emit that take loans from the bank. And so that's then ultimately what in this paper we are trying to look at.
So could you talk about those two motivations a little bit more? So one is a sort of traditional motivation for why a central bank might take climate risk into account, which is that it creates a new form of financial risk for entities. But the other you referred to in the end of your remarks there is a slightly more activist approach, which is you're trying to use bank capital requirements to create incentives for the private sector to mitigate climate change. Can you just talk about those two motivations a little bit more?
Yeah. So as you point out, the traditional classic objective, how we think about a bank regulator, is what in regulatory speak people call the prudential objective. What that really means is, as you said, it is an objective that thinks about a trade-off between, let's say, broadly speaking, economic growth or output. So this is something that governments and regulators do want to encourage. So the banking sector hopefully is intermediating credit to companies that then can invest, can create jobs, can foster economic growth. But of course, in doing so, as banks make these loans, the regulator does not want banks to become too risky. That was the role that we just discussed, that you don't want all of this to be funded with fragile short-term debt or deposits. Right? And so the prudential mandate, as people call it, is one where the regulator is trying to solve that trade-off. Banking sector should help create economic activity, but there should be a limit to how much risk there is in the banking sector. And so, of course, then in the context of climate, the question is, well, are there risks that in this type of prudential capital regulation that we've had for quite some time now, are there risks that maybe we have not yet incorporated that we should be incorporating going forward? One way I think to think about it is that there are some risks if we look backwards and we look at historical data and we try to figure out how risky are certain investments. We have a pretty good idea just by looking backwards in time what those risks are. We can look at certain types of loans, how often do certain types of borrowers with a particular rating, say, of a particular credit quality default, and then you can try to calibrate the capital requirement accordingly just based on what we've already seen. But of course, climate risks might be somewhat difficult in the sense that some of those risks, physical risks, for example, more extreme weather, droughts, heat, but also transition risks, so risks that happen as the world or countries transition to a more low carbon economy and perhaps put additional regulation in place or introduce carbon taxes, and that will change the valuation of certain assets. Those types of risks we don't yet see in the historical data. And so, so in terms of the prudential motivation that which is a traditional one, as we just said, the capital regulator should start thinking about what those additional climate risks that might appear going forward are, and then think about how they should potentially be incorporated in capital requirements. The second role that you mentioned would be a bigger departure from what bank regulators have done traditionally. In that, let's say, broader definition of a mandate for banks, for central banks and bank regulators, it is no longer just about risks, be it regular credit risks and maybe new climate risks, but now capital regulation is, if you want, meant to do another job, which is try to directly help along the transition to a lower carbon economy by discouraging banks to make loans to an oil company or another high polluting company, and maybe make more loans to greener companies, right? And so it's a different objective, or an additional objective, which is not just the risk and financial stability perspective that we've traditionally looked at, but a more activist, as you said, role in trying to support perhaps government policies to move along with the transition and reduce emissions. And I think that's a fascinating question and a very controversial question. To what extent bank capital regulation is actually in a good position to try to achieve that goal or not?
So let's dig into each of those two motivations a little bit more. And let's start with the traditional prudential motivation. And I think perhaps unsurprisingly, you find that there is a role for this to be taken into account by banking regulators. But, as an example of the beauty of theory research, there are some quite counterintuitive, or maybe surprisingly nuanced results that come out about whether the risks that you're talking about are physical or transition risks, or whether they're large or small risks. So can you just talk about what your model shows for that prudential mandate?
So let's start with this traditional or classic role of the prudential mandate. And so there, what we try to capture in the model is that there are different types of borrowers. In this particular application, you can think about cleaner companies and dirtier companies, so higher and lower emission companies that try to get loans from the banking sector, and the capital regulator is thinking about whether to condition capital requirements on is this a loan to a green or a non-green company, but in this case still just with their eye on the risk angle, right? So just under the prudential mandate. And so the first thing I think that you have to think about, and you mentioned physical or transition risks, is what type of risks do we see going forward that are not yet captured, and what would those risks look like? There's a big discussion right now about when will physical risks hit the financial sector and to what extent, when will transition risks materialize. My view, and that's what we focus on in the paper, is that perhaps at least over the medium horizon, from a bank regulatory perspective, transition risks are risks that we might want to particularly focus on. Broadly speaking, in my mind of this with a simple model, the way I think we can distinguish between transition and physical risks is physical risks in a way affect everybody. It might, of course, in practice depend on your location and so on, but whether you are high emitting or low emitting firm is not that connected with whether you are hit by a hurricane or whatever the physical risk is. But transition risks will hit in particular companies that are quite reliant on high emitting production processes, technologies. And how do those risks materialize? Well, we could think about me and you, consumers, maybe stop buying from those companies. That's one channel. So a change in taste of what consumers do. But then perhaps even more importantly, changes in environmental regulation, in carbon taxation that we might see over the next few years. And those are going to hit mainly dirty or high polluting firms. And so from a prudential perspective, thinking about those transition risks becomes an exercise in asking, well, if going forward we think the high polluting firms become riskier than they used to be or become less profitable than they used to be, how do we change their capital requirements? And so that's what we work through in the context of the model that we've developed for this paper. And what we find, you were mentioning early on, it is to some extent, I think, intuitive. To some extent, there are subtleties in there. I think the intuitive result, let's start with that, is that, as you might imagine, if dirty, high-emitting companies become riskier or less profitable, then from a financial stability perspective, you would say, well, those loans, because of those additional risks that we're now trying to incorporate, should have a higher capital requirement than they used to have. And I think that's intuitive. It does, in a way, what we've always done, which is reflect the riskiness of a loan in the capital requirement. And here it's just a risk that perhaps looking backwards, in time, we had not yet incorporated, but going forward, we think those risks will appear. One concrete example would be maybe we've run a stress test at the central bank and we figured out, well, polluting companies do not look as attractive in terms of risk, in terms of profitability going forward as they used to. Hence, it makes sense to increase the capital requirement, something that regulators call a Brown penalizing factor. What's more interesting in my view, and I think this is something, when I said at the beginning that perhaps the policy discussion was ahead of what we know from academic research, is the effect that this might or might not have on green companies. For example, and this is something where I think maybe one can illustrate the usefulness of a model. For example, one thing you might think before writing down a model is that, well, if you raise the capital requirement for a high polluting company, then maybe fewer of those loans are going to be made. That sounds, I think, a priori like a plausible conclusion. But of course, a model helps you, I think through that with a little bit more discipline. This is another way how I think about models. It imposes discipline on your thinking. You're disciplining yourself with a model, with something that forces you to think logically. And so then what you discover is that it could actually very well be that I raise your capital requirement for dirty, high-polluting loans, but perhaps those are loans that you find quite profitable anyway as a bank. And so your reaction will be, well, perhaps I don't like the fact that the capital requirement has gone up, but those are some of my most profitable loans. I'll continue to make them, but now more of my equity capital is used for those loans. And so what might actually happen is that the last loan you made yesterday was to a wind farm operator. And now it turns out that you haven't yet signed the contract. You turn around and you say, look, I'm sorry, my capital requirements for my higher polluting loans have gone up, but I'm still going to make those loans because they're very profitable for me. So there's something has to give. And it could be that this loan that you were going to make to the wind farm operator now is a loan that you no longer make. So this distinction, if we take a step back, that our model, I think, highlights is that if you increase or decrease capital requirements for a particular borrower, where do we see the impact in terms of credit allocation, in terms of loans that are made? Are there more green or more brown loans, or what happens? You always have to think about, well, what is the marginal loan or the last loan that the bank has been making, right? And so, as it turns out, coming back to the prudential role of capital requirements, if because of transition risk, high polluting firms become riskier, it makes sense to increase the capital requirement for those. And then for clean firms, we show it actually depends, and it could be, as in the example I just gave you, that as part of the optimal response of a prudential regulator, one who thinks only about financial stability, it's actually the wind farm loan that gets crowded out at the margin. So I think that's one, coming back to the question, what does theory give us? I think one interesting implication that this model gives us that maybe ahead of time I would not have necessarily anticipated. In fact, I'll give you one more result that really surprised us. In fact, even the capital requirement for clean firms, even that one could go up in a scenario where just the transition risk for the dirty borrowers have increased. And that's the case when the last loan that you made is actually a loan to a high-emitting, a dirty company. And we were talking earlier on about what's the trade-off that the bank capital regulator is trying to solve. Well, it's making the loans that are being made less risky, more loss absorption capacity so that banks don't go bust. But of course, the cost of doing that, we were talking about economic activity or economic growth, is the higher capital requirements are most likely the banks are going to make fewer loans. But if the last loan, in contrast to our last example, is actually one to a high emitting, to a polluting company, then the capital regulator will say, well, actually, at the margin, so these additional loans that could be made, if they're actually loans that are subject to transition risks, and if transition risks have gone up, then I want to focus more on making the existing loans, including the clean loans, safer, as opposed to making one more additional loan that's subject to transition risk. So in that case, actually, both capital requirements, one way to summarize it is lending opportunities in the economy have gotten worse, so it makes more sense to have more capital to absorb losses for existing loans as opposed to making one more loan. So that illustrates that the effect on capital requirements to clean firms of when we think about transition risk can actually be, as you mentioned, quite subtle. And so the model, the map, as we said at the beginning, can hopefully then give some guidance to regulators in terms of how do we think about that and how do we adjust, update our prudential policy in the face of transition risks.
I think that's an absolutely fascinating example. And I mean, there's often this lazy assumption that attractive climate policy and prudential risk, everything's going to point in the same direction. But I think your paper shows that these things are very, very subtle and can point in different directions. And so let's come on a little bit more now to this sort of expanded remit idea. So in recent years, I think there's sort of been increasing support for the idea that actually capital requirements could be another tool in the toolkit for somehow directing capital away from dirty firms by making it more expensive and towards clean firms by making it cheaper. Is this the sort of thing, in your view, that central banks should be getting involved with?
That's indeed been a big topic of discussion over the last few years. And most economists, if this is something you would drop in as a question at lunch here at the LSE, right? I think the initial response, and that I think is a useful starting point to think about this issue, would be, well, but hang on, if we think carbon emissions cause what economists call externalities, so firms that emit don't internalize all the damage that they're doing, say, to the climate, and so there's role for intervention to reduce them. The first tool an economist would throw into the hat would be, well, hang on, we know from almost people sometimes say Econ 101. The first econ course when you learn about externalities is, you should tax externalities. The carbon tax, the more generally speaking Pigouvian tax that economists always very much like. And so as a starting point to think about this broader mandate that you asked, should central banks think about emissions because they cause externalities and the private sector doesn't internalize that? I think the first question to ask is, have those emissions been taken into account in some other way, in particular through carbon taxes? And so this kind of starting point or benchmark result is that if we were in a world where the government has set carbon taxes optimally, then actually that should take care of the carbon externalities. It should point us in the right direction in terms of the transition. And so in that scenario, actually, and this is something we prove or show explicitly in the paper, it would be optimal to have the government set the carbon tax optimally and then tell the bank regulator, by the way, you don't have to worry about carbon emissions. You should worry about climate risk to the extent that that's part of your prudential, the financial stability objective, but actually let us, the government, use the carbon tax to deal with emissions, right? And so then actually we're in a world where what central banks do right now, or what I should say bank regulators do right now in terms of capital regulation, follow a prudential mandate, would actually still be optimal, even in a world where we're trying to transition to a lower carbon economy.
Right, so the optimal outcome is that the government deals with the externality and there's not a mixed model that deals with the externality. But of course, we're not in the optimal outcome, and probably carbon taxes are too low. So in a world where carbon taxes are too low, what then? Is there then a role for, can capital requirements ever sort of fill the gap that's left by inadequate carbon taxes? And if not, why not?
Right. I think the underlying argument is that carbon taxes are not where they should be, and I think we probably know that that's true. Carbon taxes are not at they do not capture the social price of carbon, and so then, as you say, Tom, the question becomes, well, to what extent can bank capital regulation do the job that carbon taxes should be doing? What makes the question interesting is that, of course, capital requirements at the same time are still meant to also do the other job, which is the financial stability, the prudential job, right? And so that's what we're then trying to find out in our paper, which is can you do both jobs at the same time but only have one tool, the capital requirement? So you now want to address emissions themselves. You also want to deal with the prudential objective. There's, if you take 3 steps back from what we're discussing today, there's a kind of a famous result in economics referred to as the Tinbergen rule, which is, well, usually if you have 2 goals, you need 2 instruments, right? So earlier on we had the carbon tax and bank capital regulation. Now we're trying to figure out, well, here, is it the case that perhaps one tool is enough to do both? And this, Tom, is what you mentioned earlier on when you said, well, sometimes people think these 2 objectives go in the same direction, right? That would be the case where we have this, I think sometimes people use the word divine coincidence, where by solving the prudential goal, we actually also kind of as a useful byproduct reduce emissions. But actually, even without going further, we already know from our previous discussion that that's not going to be the case, because one of the examples we were discussing earlier on is that sometimes when you raise capital requirements for high-emitting loans or Brown penalizing factor, if the last loan you made, your wind farm is one to a clean borrower, that might get crowded out. So in that case, the prudential goal and the reducing emissions goal do not go hand in hand.
In fact, quite the opposite, they conflict.
They can go in the opposite direction. And so effectively then we work through that in our model. And the key issue, to cut to the chase and explain why, and this is ultimately our message, why capital requirements can usually not do both jobs at the same time, is that you will sometimes be in a situation where, as we just discussed, the 2 goals conflict. Again, an example would be, suppose you have 2 loans that you're looking at, or 2 types of loans. Some are high-emitting loans that, in the extreme case, maybe you don't want them to even happen anymore because socially it's just too much carbon that these emit. And then there's a greener loan that you would like to happen, and you could do that with a carbon tax if it's available, but suppose now the carbon tax is not there, can capital requirements do it? And so the problem you run into is, what you would like to do is, raise the capital requirement for polluting loan to make it unattractive, and then set the capital requirement for the clean loan that you still want to make to meet your prudential objective. But you can be in a situation where that's not going to work. Even if you've raised the capital requirement for the loans you don't like, and then you set the capital requirement that you like for the clean loan, the bank might actually prefer to still make the polluting loan if that's a profitable loan. Even in the extreme, we set capital requirements all the way to 100%. You tell the bank, all of this has to come from your equity. They might still want to make that loan. And then you can do one of 2 things, and both of them are going to be costly. One would be to say, well, in that case, maybe in addition to raising capital requirements for the high-emitting loans, we're going to lower capital requirements for clean loans. And in fact, that's something regulators talk about sometimes. It's called a green supporting factor. But if you do that if you have to do that starting from the point where you actually meet your prudential objective, right, then you are sacrificing something on that margin. Right, so now you have 2 goals that are in conflict. In order to get the clean loan funded and not the dirty loan, you actually have to deviate from your prudential goal. So there's going to be a sacrifice because you're trying to do 2 things with 1 tool of the prudential objective. In fact, you could even be in a situation where, once you look at it, that sacrifice of your prudential objective could be so high that, as a bank capital regulator, even though perhaps you've been told you should also think about emissions, you don't find it optimal to do so. You might actually say, well, trying to reduce emissions takes so much away from our prudential objective that we actually prefer not to do it. And so that's why, as a direct replacement for a carbon tax, capital requirements, they can't do it 1-for-1 because you run into this conflict with the traditional prudential mandate.
So although you're pretty clear that bank capital requirements can't replace a carbon tax for all the reasons you've just described. You do highlight a sort of indirect way in which they can improve the credibility of climate policy. Can you just expand on that?
Yes. So, as you say, Tom, the takeaway from the previous part is that if we were hoping that we can just replace a carbon tax with capital requirements and have them do two jobs at the same time, that's likely not going to work. And I think it is very important for society to address the problem of carbon emissions. I think it's also important to be academically honest about tools that might, even though we're trying to do the right thing, might not be the right tool. But I do think, and this is what you're alluding to, that capital requirements can still play a role in the transition to a lower carbon economy and addressing climate change. And that role actually is not as a direct substitute for a carbon tax, but as what I sometimes like to think of as a facilitator of carbon taxation. Now, how do those two things go together, or what's the connection here between, because you might say, well, one's broadly speaking environmental regulation, one is financial regulation, capital regulation, so what's the connection here? The connection comes back to the transition risks we were talking about earlier on, that most likely as we get more serious about the transition, certain assets that are quite valuable right now may be much less valuable. And I'm thinking here in particular about carbon intensive oil and gas, these types of investments. Now, the banking sector has significant exposure. These are, large firms. Banking sector has a lot of exposure to those activities, and so one friction that might be holding back governments, we were saying earlier on, well, probably carbon taxes aren't as high as they should be. Well, one friction that might be holding back policymakers is that there's a reluctance to be as aggressive about carbon taxes as you might want to be, because you worry that in doing so, in raising carbon taxes, you will cause significant losses in the banking sector. And we know from 2008, 2009, of course, that was not related to carbon or transition, but we know how costly it is for governments to be in that type of situation and all the repercussions. So it's politicians do not want to be in that situation of bailing out and supporting financial institutions. And that's where bank capital requirements come in. The problem I just discussed, sometimes people refer to that as stranded assets or stranded asset risk. So these oil and gas assets are stranded in a way. They are now maybe not worthless, but worth much less than they used to be. And the banking sector might sit on those risks. And so capital requirements, of course, can prepare the banking sector to absorb those losses. In other words, if the capital regulator makes sure ahead of time that capital requirements are sufficient, that these transition risks do not lead to banking crises, to runs on banks, to government intervention, then it becomes much more credible for governments to actually do their job. And so the ECB, if you look at the publications they have on climate change or the speeches that ECB governors give, usually one of the talking points is, well, first and foremost, climate is the role of the government, and then the ECB can play a supporting role perhaps. And what we're just discussing is, I think, one of those supporting roles. In fact, enabling governments to be more forceful in fighting climate change by making sure through capital regulation that the banking sector is not going to be in crisis once the transition really gets underway. And so that's the role in terms of a policy message that if I were asked, I would give to policymakers would be not to try to use capital requirements as a direct substitute for the carbon tax, but make sure that via the correct capital regulation, the financial sector is in a position to deal with the transition risks that will arise when carbon taxes go up, which in turn will make it more likely that governments will actually find the will to act more forcefully than they have in the past decade.
Very interesting. To wrap up the discussion, I'd like to bring us back to the role of theory. And I hope that it's going to have been really obvious to our listeners from this discussion, but perhaps let's just could you just explain how is it then that a theory paper enables us to get an insight on these issues in a way that an empirical analysis really never can?
As a starting point, I think of theory and empirical research not kind of one versus the other, but a back and forth, a conversation, right? That applied theory researchers like me have with empirical researchers, and so it's not, of course, one versus the other or one or the other. It's a back and forth between the two. I do think that in this particular case that we were talking about bank capital regulation and also some of the other questions that I've tried to think about in my research, here we're in a situation where we are trying to get guidance on a policy, capital regulation, something that's quite important for the banking sector, for the financial sector as a whole, for the economy, in fact. But of course, these regulations are not yet in place, and so it's actually difficult to do an empirical analysis and try to find out, well, what's actually happening. Let's look at the data. And so in that situation, the map, the guidance from theory, I think, is particularly important. And so thinking through this model that we've just discussed and maybe other theory research on this topic, then my hope would be that policymakers will find it easier to come up with regulation that makes sense going forward. What should this updating of capital regulation look like? But actually, since you asked, our discussion, I think, also highlights what the type of model we're just discussing cannot do, right? So one key question that came up early on in our discussion was, well, when I raise capital requirements for, say, a dirty loan, who's going to be affected? And we were talking about the fact, well, you have to think as a regulator about, well, what's the last loan, the marginal loan that a bank makes, right? Theory can point out, well, that's the loan you want to think about, who gets crowded in or crowded out if capital requirements go up or down. But that ultimately is an empirical question, right? So, and that comes back to this conversation, I think, between theory and empirics, that based on that insight, empirical research should look at, well, can we say something about what is at the margin of or the last loan that the banking sector makes, and does it vary over time? And are those high-emitting loans, low-emitting loans, both a priori? As a theorist, I don't know the answer to that question, so that's where I have to ask my my empirical colleagues to continue the conversation, and then also perhaps based on those empirical findings, feed them back into the types of theory models that we were discussing today.
I love that description of the relationship between theory and empirics as a conversation that goes backwards and forwards. I think that's a great ending point. Martin, thanks for a terrific discussion.
It's really been a pleasure, Tom. I really enjoyed talking to you. Thanks very much.
You've been listening to the Financing a Sustainable Future podcast with me, Tom Gosling. If you enjoyed the conversation, please like, share and subscribe on your favourite platform. To find out more about the work of the Initiative in Sustainable Finance, which is funded by the Global School of Sustainability here at LSE, please go to fmg.ac.uk/ISF.